People just don't know enough about financial education. The UK's tax system at the moment is just so complicated.
Charlotte, the tax queen, is in charge of the entire UK tax system. Yeah. What would you change?
They need to scrap everything and start from scratch. I would significantly reduce spending. I would do a complete overhaul of the welfare system. Tax affects everybody. You can guarantee it's going to affect some part of your life. They need to know the different taxes so that they can get their finances in order and not absolutely panic. Don't wait until you're ready, because the earlier you start, the more time you have to grow. I don't believe that you should be putting everything into your pension because you can't access it for many, many years. You should be planning for your future and for freedom. You should be planning to enjoy your life.
We are joined today by tax royalty, Charlotte Brooke, tax queen.
Yeah.
So tell me, who is Charlotte and who is the tax queen?
Well, Charlotte and the tax queen are very much the same. So Charlotte did the ACA at Deloitte and became a chartered accountant and was just kind of like just living the normal accountant life, kind of just the day-to-day job. And the tax queen then came about because I kind of realized that people just don't know enough about financial education. They don't know about their taxes. And together with Pie, who I also work with, we basically have come up with the tax queen to kind of help people to give free advice on taxes, to make it less daunting, to empower people to know about their taxes.
So why was it important for Charlotte to leave the corporate world, leave that sort of excitement of big corporate taxes and help on a more personal level?
I think I kind of came to realize about, like, with my friendship group and just with family and friends and talking, tax is so unbelievably complicated. And I think people really shy away from it. And I really wanted to make it so that people could really feel empowered, know what they're doing, so it's not so daunting. And I think I'm actually giving more value to these people than I was to the big corporates, where, to be honest, I was an assistant manager at a big firm. I wasn't really adding value, and I feel like now I'm really trying to help people, giving them free information, and I think it's making a big difference. I'm getting a lot of positive feedback, which is really great.
And we've seen sort of like the tax queen and Pie like grow socials, so there's clearly like a demand for this traffic, and I suppose that leads me on nicely to why is it so crucial for people to understand the UK tax system?
Well, tax affects everybody. So that's the main thing. It's one of the things that you can guarantee it's going to affect some part of your life. The UK's tax system at the moment is just, as I said, so complicated. And it's important that people know where their money's going to go. They know that the money that they earn through their income will be subject to income tax. If they sell second property, if they sell a property, if they sell shares, they'll be subject to capital gains tax. They need to know the different taxes, because otherwise they could come to the year end and actually not have put away the right amount of money that they need to for the different taxes. So it's so important that people are aware so that they can get their finances in order and not absolutely panic when the tax year end comes to a close.
What do you see then, Charlotte, like based on Pie, based on the tax queen, what do you think are like the main challenges people face? One
of the things that really is a lot of people are struggling with is how to make their money work for them. If you get a pay rise, how can you plan efficiently to reduce the taxes? And I think that it's mainly the cost of living crisis, and also it's the money being put away. I think people really struggle with. I have had a lot of clients in the past that have come to the year end, actually not the year end, come to close to January, and they haven't got the money to pay their taxes because they haven't planned. And I think that is one of the main things that people struggle with, and that's planning. And that's another thing that if I talk, the more I talk about taxes, the more people are hearing it, and they think, actually, at the end of every month, this is how much I've earned, so this is the money that I should be putting away. And that's actually one thing that Pie has implemented, where you have a real-time tax calculator. So actually, which is something that everybody should be aware of, putting away the amount of money that they need so they're not absolutely stumped come the year end.
It's kind of like save as you earn, right?
Yes.
So like as money comes in, you're putting away to sort of cater for these tax liabilities.
Absolutely.
If you had to give like a sort of top three list of things that people should be aware of when it comes to taxes, so their financial year ends, call it January or whenever it may be.
Yeah.
What would the tax queen's 3 things be?
Plan. My first thing would be absolutely plan, so you're not stumped at the year end. Something that people need to know about, not necessarily for January, but for the tax year end, so April, is ISAs. So many people don't know about ISAs, and ISAs you have a £20,000 annual limit, and that is tax-free. Any growth is completely tax-free, and people need to know about that, because if you don't use it, you lose it. So that's a major thing. And the third thing that I would say is, this isn't actually to do with sole traders, but it's something that if you have to file a tax return if you're employed and have side hustle income. So if you're employed, you need to check your payslip. That's on you. That's not an HMRC. You've got to check it. If you think that there's the problem with it, then you contact HMRC. I've got a lot of videos on kind of PAYE tax codes you should be looking out for, but those are my 3 top things.
If tax planning is so important, like that's your number one priority, it's the one thing that you want most people to hit.
Yes.
We can do that with ISAs. Obviously, InvestEngine has a flexible ISA, so you can, whatever you withdraw, if you need to draw on that money, you can top it back up and it not affect your tax allowance.
Yeah.
Which is really cool, because it means if you've got £1,000 in but you need 500 back out,
Yes.
you don't have 19 grand tax allowance, you have the 19,500, because it's flexible. But how can people, I understand how people can plan with ISAs, but how can they plan when the budget's coming up and there's a lot of talk around reducing the limit on cash ISAs?
Yeah.
No one really knows, obviously nothing's set in stone what's going to happen, but how do you plan when an event like this is so close?
Well, the first thing I always say is don't panic and don't just rush into doing something, because normally when the budget comes out, things don't come into play until a few months later. It's normally the new tax changes come into play the following April. So the first thing, if you're not sure what to do, just don't do anything for now and just wait and see what happens, because there is a lot of uncertainty. The only thing I actually would say, which I don't normally say, this is completely going against what I've just said, is the fact that they're talking about potentially reducing the cash ISA amount from £20,000 to £10,000. If you are set on putting your money into a cash ISA, I would put it in now. You won't lose anything by putting it in now. If you want to max out £20,000, that's what I would do, because that I really think is one of the things that could be changing. But other than that, I would just sit and I would wait, and don't panic, because, I'll be giving a lot of information out after. I'm sure you will be as well, to try and help people and guide them through the changes that will be happening.
Yeah. And of course, it's not financial advice, but I think just to put it in layman's, what you're telling the people who tune in is make the most of it now.
Yeah.
And then just wait. The important thing is plan now, don't panic, use it if you need to. And then again, with a flexible ISA, you can just withdraw it if you need to as well.
Yeah.
So again, don't panic and make use of it where we can.
Absolutely.
So using tax to your advantage then, if we look at things like side hustles, what are the sort of tax advantages that are out there that people can draw on to help their income stretch a bit further?
So other than cash ISAs, I always recommend putting your money into SIPs, because you can lower your income tax rate by doing so. So for example, if you get a pay rise and you earn over £100,000, you start losing your personal allowance over £100,000. So let's say you're on £110,000, you can put that £10,000 into a SIP, and therefore you're not starting to lose any of your personal allowance. It's just things like that you should be incorporating into your saving strategy. Another thing that I recommend is, alongside ISAs, it's another type of ISA, is a junior ISA. So if you've got children, you can get a junior ISA, which you can max out at £9,000 a year. That's just another thing to think about for yourself. If you're trying to put money aside for your children, that's like it's a completely tax-free way of growing money for them.
On junior ISAs and in fact junior SIPs, this is really interesting actually, because it doesn't matter whether you are a single parent or whether you are or whether you're married. The limits, the tax limits, are always on the individual. So for the junior ISAs, if you mentioned £9,000, but even if you are a higher rate taxpayer, and I've always kind of thought about this as a disservice really, if you are a higher rate taxpayer or an additional rate taxpayer, you don't actually benefit from the extra relief in a junior SIP, because child doesn't pay tax, which is why the limit is 3,600,
Right.
which is also the limit that you can put into a SIP, including tax relief. I think it's 2,880 net or gross, and then topped up by the government. So that tax allowance is always on the child, not you. So for anyone who uses a junior SIP, they will only ever be able to claim the 20% for the child's tax allowance, not your tax allowance, which even though you're the one paying,
Yes.
you don't get that back.
Fine, that's interesting.
Yeah.
That does make sense, though.
Well, I mean, it's if you're the one paying, that was coming out of my income, right?
Yeah.
So like, if I'm paying it, I know it's for the child, but,
Yeah.
and the child doesn't earn,
Yes.
but I'm paying it. So
Yeah, you're right.
yeah, I just feel like there should be some sort of, I don't know, allowance for that.
Yeah.
Because you get it on your own. You get it on your own pension.
Yes.
Right? Like your workplace pension, you
Yes.
get the additional rate. Your self-invested personal pension, your SIP, you get it, and they're all things that you pay into.
Yes.
And then you pay into your child's junior SIP,
Yeah.
and you don't get it.
I guess they're just focusing on the actual recipient and the amount. Yeah, that's very interesting, actually. But I guess maybe when they don't have access to their SIP. I was going to say when they have access when they're 18. I mean, of course, they will be investing. Oh, that's obviously why, because
You'll have
they will be,
control of it.
yes.
Yeah.
But if they're investing from 18, I guess it's assumed, unless you're in a very, I don't know, different situation where you're a high rate taxpayer at the age of 18, but I guess they'll automatically be, if they earn anything, basic rate. So I guess that's what they're leaning into. But
Yeah, perhaps. Which is why the tax allowance is probably 2,880 as well, because
Yes.
if you don't earn an income, the max you can pay into a pension. If you don't earn an
Yes.
earned income, the
Yes,
max you
max.
can pay a pension is 2,880,
Yes, you're right.
3,600 in total. So that could be why they're not the taxpayer, so therefore they get the non-taxpayer allowance.
yeah.
And I think as well, like with this, as you mentioned, like the cost of living crisis at the top of this podcast, we look at like how expensive it is now and how much like prices have increased. If it is quite scary, like I'm a dad, you're a mum, like it's quite scary looking at like, you know, what prices our children will have to pay. You know, I mean, who knows? We can talk about ISA limits and like how much you can save tax free, but one thing I think most people can generally agree on is like prices are going up. Inflation does rise.
Yeah.
So that cost of capital or that cost of goods, if you can do the most to bring that down for your children, is probably a sensible idea.
Absolutely.
Pie and InvestEngine have partnered to work together to help people lower tax liability and use like their pension to reclaim additional tax relief. So for those who don't know, the InvestEngine pension and most pensions or a lot of pensions give what's called relief at source. So that is where whatever you put in, InvestEngine will claim 20% back from the government on your behalf. But for a lot of high earners, so either those in the higher rate or additional rate, they can claim that additional 20-25% tax relief back. So InvestEngine Pie have partnered to help clients with that. Talk me through why that's important and why this is really great.
So it's really important because, first of all, a lot of people don't know that they can reclaim that additional 20-25%. They have to do it through a self-assessment. So even if, I mean, I don't know about your clients, but I assume a lot of them will be employed. So they'll be putting some of their earnings, their salary earnings, into their pension every month. They then, if they want to get the additional income, even if they don't earn any other income that they need to put through a self-assessment, they need to file a self-assessment to get that reclaim, that tax reclaim back. And they can do that through Pie. So it just makes the process, we think together, very seamless. So they can invest their money with you and then, or through your platform, and then they can get the additional relief through their self-assessment. Or if they sell their shares, if they are not in an ISA, they're not in a tax efficient vehicle. So if they're in your GIA account, they can then sell their shares, pay their capital gains through self-assessment through the Pie app.
So it will do the capital gains, it will do the additional pension relief. It's all recorded on like transaction level because you connect through open banking, right? So all of that is done. It's really simple for clients.
Exactly. And also because one of the great things about Pie is that we support multiple income types. So all of their income is on the Pie app already. Then all of their their trades from, if they have to pay tax on them, from InvestEngine flow through seamlessly to the app. So everything is there together. The whole aim is to try and make the experience for the user, for both of our users, as seamless and as easy as possible. And that's why this partnership's come about, really.
So if a user has multiple income streams, maybe they have a couple of rental portfolios, they have a side hustle, they have earned income through employment, they can use the InvestEngine SIP and that partnership with Pie. It doesn't have to necessarily be tied, but they can use that to report everything to HMRC to get their tax back.
Absolutely. It's so seamless. All of, as you've said, through open banking, all the transactions come up on the Pie app. So you can allocate it accordingly, to your different kind of income streams, and then it just all flows through to HMRC. So it's really, straightforward.
So what is the personal allowance and the different tax bands?
Okay, so the personal allowance, which is so important for everybody to know because it applies to everyone, is your tax, the amount of income that you can earn and not pay a penny of tax on it. So the personal allowance is £12,570. After that, you start paying basic rate tax at 20% up until the next threshold of £50,270. After that, you pay 40% of tax, and then you pay 45% above that. So those are the different tax bands. It must be noted that after you reach £100,000, your personal allowance starts to diminish. For every £2 that you earn over £100,000, your personal allowance gets reduced by £1. So once you reach £125,140, you do not have a personal allowance anymore.
And you don't pay income, you don't pay those levels of tax on the whole amount, right? So once you earn over 12,570,
yes,
you don't pay 20% on everything, including that.
No. So the UK tax system is a progressive system. Okay. So you only pay the amount, you only pay 40%. Let's say you earn £55,000, you only pay the 40% of the income between £50,270 and £55,000, only on that. So that's why it's actually quite an interesting one. I've had a few people message me in the past about not wanting any sort of tax rise. They don't want to go over the £50,270 threshold for fear that all of a sudden all of their income that they've earned up until, well, not up until now, but in the future, all of it up until that new pay rise amount is going to be subject to 40%. So it's very important that I say to everybody, we have a progressive tax system, so that will not happen.
I never say no to a pay rise.
Never say no to a pay rise, absolutely. Yeah. But also, if you put your money into a SIP, you will not be paying tax on that money. That money goes into the SIP before your tax on it. It's your gross income. So that's why it's so important to know, to understand SIPs and ISAs and all these sort of tax efficient vehicles so that you are prepared and if you get that pay rise, you know exactly what you're going to do with that money.
So is there a way, I mean, we've already touched on this, but legally avoiding tax is the strategy very much, again, using those same vehicles? Using
the same vehicles, but it also depends what your tax band is. So for example, there is such thing as the marriage allowance. So if you are a basic rate taxpayer, so if you're in a partnership and as in a civil partnership and you are a basic rate taxpayer and your partner earns under the personal allowance of £12,570, you can actually transfer 10% of that to your partner. So you're saving £252. I know it doesn't seem like a lot, but all these little things do add up. So there are lots of different ways you can be saving taxes. Of course, with capital gains, you've got your annual allowance. There are lots of kind of loopholes and ways to legally reduce your taxes. You've just got to be aware of them.
Where does someone go to find this information? Are there any other resources that people can draw on?
You can look online. The information is there. It is a bit complicated and it's quite difficult to actually sift through and find what you want. I'm always on hand if anyone has any specific questions, and I'll always help you. But I think that it is quite difficult, and that's one thing that I think needs to change.
What do you teach your kids about tax, finance? What do you use to do?
Okay, well, mine are very young, so they're not learning about any of that yet. Yeah. But what I would say to kind of family members is going back to planning and saving. When I say saving, I don't mean literally putting it into a bank, investing it, putting it into ISAs. I feel like I just keep saying badgering on and saying the same thing, but you have to make your money work for you, because no one else is going to make it work for you. You don't need the newest items, you don't need to spend it. You should enjoy your life. Of course you should. Take the holiday with your family or whatever you want to do. But you should be planning for your future and for freedom. So I don't believe that you should be putting everything into your pension, because you can't access it for many, many years, which is why I think the ISAs are really amazing. But you should be planning to enjoy your life. But I think it's very important for people to have money put aside for a rainy day. If they're stuck, if something happens in an emergency, or something they're not expecting, it's good to always have money put aside. So that's what I would say.
Yeah, and I think the last thing, like family wants, and everyone knows how like hectic family life can be, and whether that's like single, whether that's married with children, just with children, like life is busy for many. And I think, it's really important to cast a balance between like saving for ISAs, which is maybe your 5-10 year goal, saving for your pensions, which may be a 20-30 year goal. But if the boiler breaks tomorrow, what do you do, right?
Absolutely.
So in terms of like actionable next steps that like families, people listening, or any individual can take, what would be your sort of like checklist of like, you've listened to this podcast, you've gone to get information, like these are probably the next 3 things that you should put in place?
First of all, I would say before you put anything in place, you need to, something I should have just said before, is talk to your partner. So you should have everything laid out. You should have all your finances laid out, and then you can plan. Don't kind of have your head in the clouds and hope that everything's going to be okay. You've got to start. Even if, one of the things I always say is, even if you're not ready, you don't wait until you're ready. You start today. So you have all of your finances written down, and then you allocate things. So you figure out how much money you want to have in 10 years time, 15 years time. So as you said, you have your short-term goals for then. You have to put aside money. You have to think about the amount of money that the both of you will need when you enter into retirement. And then you can figure out how much money you should be putting away in different vehicles. That's what I would do.
Yeah. So again, it comes back to that planning piece, right?
Yeah.
So like lay it all out, clear plan, and then action, right? I've allocated certain capital to these certain things, and this is how much is left that I can invest, I can save, or I can, plan, which I think is key. So in terms of like what happens with the budget, I mean, this is going to go out very close to it.
Yeah.
What key things should people look out for? Like, are there alarming things that you're looking at? Are there things that you want people to understand, or any changes that you think will come up?
So I think that the cash ISA change will happen. Something that I think is really worrying, but I do think it's going to happen, even though it doesn't sound bad, I think it could be quite bad. It's the continuous freezing of the thresholds, the income band thresholds.
Okay.
So as we said, the personal allowance is £12,570. The higher rate threshold is £50,270. That is frozen until 2028. There are talks of it being frozen beyond 2028, maybe 2030, continuing on. And even though that is not an actual income tax rise, it essentially is. They call it a stealth tax, because as salaries go up, if the threshold stays as it is and salaries go up, more people are going to be having to pay tax. And I think that's really unfair, and I think that's really worrying for a lot of people. And I think that they're going to play it in a way that they're not increasing taxes, when actually that could be really detrimental. Another thing that I think they might change, actually it's 2 things. I think they might make changes to pensions and inheritance tax. Bear in mind, this is based on nothing. I'm completely guessing this, but I feel
it's
like
locked away until the 26th of November.
Exactly.
Right?
And I have absolutely no idea what they're going to do. But they're already talking. Well, they've already said that pensions will come into your inheritance tax estate come April 2027, which they've never done before. I think they could make changes on the amount of money that you can draw down in a tax-free lump sum, which is currently around 258,000.
That's the lifetime allowance, right? Yeah.
Yes.
So 25% tax-free, but a cap of 250,000.
Yeah. I think they might reduce that.
Okay.
I just feel like that could be an easy way for them to bring in more money. I also feel like with the inheritance tax, so at the moment, just kind of a brief overhaul of what's kind of going on with inheritance tax. So when you die, you have to pay 40% of your estate to inheritance tax. But there's a taper relief. So if you give a gift, and then if you give a gift to your child and you survive 7 years after giving that gift, it's inheritance tax free. But if you give a gift and unfortunately you die 3 years later, you don't pay the full 40%. It's called a tapered relief. So you'll pay a smaller amount of inheritance tax, but you'll still have to pay inheritance tax. I have a feeling they're going to increase that 7 years to something like 10 years. So actually you have to give a gift and survive 10 years. Otherwise it will be pulled back into your estate.
And that's probably to stop people trying to give gifts in order to avoid it, right? Cash ISAs might be changing. We talked about that. They may go, it's on the table that they may go from £20,000 a year to £10,000 a year, or maybe even 4. But they're different to stocks and shares ISAs, right? That tax allowance isn't changing. So people will be able to still invest £20,000 tax free.
Yeah.
Flexibly if it's in an InvestEngine ISA, for example. But the amount you can pay into a cash ISA is lowering, right?
Yeah, so it's basically taking away your choice of where you'll put your ISA money. So you'll still have, as you said, the £20,000 annual limit. But what there's speculation on is that you will only be able to put 10,000 into a cash ISA. And the other £10,000 you can put into either stocks and shares ISA or a lifetime ISA. So those are the different ones. But the fact of the matter is, if you wanted to put £20,000 into a stocks and shares ISA today, you will still be able to do that if there's a change. It's just the cash ISA amount might be reduced to £10,000.
But so right now, I couldn't put £20,000 into a stocks and shares ISA and 20,000 into a cash ISA.
The ISA, you only have £20,000 in total across all ISAs. That's very important.
So when they reduce the available amount on a cash ISA,
yes,
they will cap that at 10.
Yeah.
And then you'll still have 20,000, or you'll have the remaining.
You'll have the remaining 10,000 to put elsewhere.
Fine. And so if it's 4, it'll be the remaining 16.
Yes.
Sure.
I mean, I actually don't know what they're going to do. They were talking about reducing it to 4, and I think there was just like complete uproar about it. And now they're kind of throwing around the £10,000 figure. So I do think it's something that could change. But do you think that it's a good thing?
I think it's encouraging that the UK is sort of taking a growth mindset of getting people to invest. Like, I mean, if you can get people to build wealth, we know historically that investing has done better than cash saving. Mm-hmm. Yes, you've got to handle a little bit more volatility. Yes, there are uncertainties. But if we can get the country to take an investor mindset, I think we're encouraged to maybe take a little bit more risk, or maybe be a bit more entrepreneurial. Mm-hmm. I think it can only build prosperity within the country. I think it's a good thing. I think it would be sensible maybe to split the allowances. Mm-hmm. I think it just adds further complexity. Okay, you have £4,000 in cash, but it's the same allowance, but they're not separate. Yeah. But they are treated as separate.
It's just another way of making something that could be so simple confusing.
Because it's the same with lifetime ISA, right? Lifetime ISA is a separate allowance, but it's an ISA. Yeah. And then you've got what they're could be referring to as the sort of British Innovation ISA. Is that right? Again, it's an ISA, but it's something else. And then you have SEIS, EIS relief schemes. Yeah. Again, it's another tax efficient vehicle, but it's a different allowance. Yeah. It's all just a bit confusing. You'd think that they could just simplify it by splitting them out. But
I also feel like a lot of people who I've spoken to feel like they're being pressured into being incredibly risk-taking, so the opposite of risk-averse. But actually, I feel like a lot of people, I mean, they should definitely use InvestEngine because you have so many ETFs and they are more risk-averse. So you don't have to just put your money, like I do, into a certain stock. Yeah. You can be, you can put it into something that is quite risk-averse. And, hopefully, I mean, because it's spread across so many companies, you're not as kind of, I don't know what the word is, you're not at risk of losing everything, because, you know, if something doesn't do as well, something else will kind of bring it back up. So
I think that's a theory, right? Like all investing carries risk, and yes, like there is a risk that like everything could blow up in our faces, and yeah, that is a risk that everyone has to kind of keep in the back of their minds. But if you're split in a sensible portfolio that is like across different geographies, different sectors and industries, and different currencies, one should hope that it plays out in the long run, as opposed to putting it in cash and settling for what has historically been, I mean, up until a couple of years ago, it's been not like 0.1%.
I know.
I mean, it doesn't do well for people's savings. That you know, you need millions to even make a reasonable amount. Whereas now, obviously, it's a bit different. But that is hopefully coming down, which will obviously do wonders for people's mortgages and other things. But sad things for people's savings, which hopefully the government will split out, and it'll make it a bit more simple. So you talk about sort of tapered relief. But obviously you've got a tapered allowance when it comes to earnings, and if you earn over 260 grand or around that figure, you can only pay in, is it 10,000 into a pension? How is that different then in terms of like an income tax? Because obviously that is a direct tax on what you can pay in to benefit from tax relief, right?
Yes. So essentially, anybody can put in £60,000 every year into their pension. That's the maximum. But the more that you earn, the less you can basically benefit from your tax relief by putting into a pension. So what they're now saying is over £260,000, that's now been reduced to £10,000 a year. So yeah, it's a big change.
And if you're earning that much, I mean, many will say like, look, it's a good income anyway. Maybe that relief isn't as necessary. But the point is, like, that financial planning piece is, again, it's another rule, right, that you have to kind of look at. And I think people forget that, as you mentioned, the salary squeeze of people being pushed into these higher brackets makes people go into territories that they don't necessarily know. You know, like you could, I would argue, you know, very easily in the city, earn over 50,270, is it? You pay higher tax relief without a college education, without a university degree. And people are never taught this. Like you talk about mortgages and other sort of savings rates, tax rates. People don't know that, okay, well, now I'm subject to this higher rate. And I can reduce it by paying into a pension or whatever it may be. I have a family member actually that has fortunately been a high rate taxpayer since he left university, so 20-some years ago. Never claimed his workplace pension. So he's now lost, because I think 4 years you can go back. So he's now lost 16 years of what he could have claimed in the 20% tax relief. So for those of you who don't know, most will be relief at source pensions. You get to claim 20% back. InvestEngine, for example, will put that into your SIP. The additional tax that you're owed, you can thankfully use Pie to claim that back through our partnership. But you can also write to HMRC or submit in your self-assessment. So many people, as you mentioned, that salary squeeze, have been pushed into that. We can't really do a lot about that, right? Because again, if people are not consuming this financial content, where do they go for this information?
I think it'd be a bit unfair to expect all workplaces to have to give that information to their employees from a cost perspective, because obviously that will cost a lot for them to do. I do think when employees start at companies, there should just be a general talk about your pay slips and about general how to claim additional relief on your pension, just general key tax information, so that everyone kind of starts with I don't want to say a level playing field, but just kind of basic information that they can then decide what to do. When it comes to earning more money and what to do with that, additional income, I do think it's down to the individual. I do think that there should be a tax-free pot where people can have a certain amount of money to put towards, one session with a financial advisor or a budgeting coach. I feel like it should almost be like a financial wellness allowance where people can have a session with a financial advisor, and it comes from kind of their tax-free money, so they don't have to pay tax on that amount of income that they're putting towards a session with a financial advisor, so that people can choose kind of what they need to learn. So, it could be a financial advisor, it could be maybe like a debt manager or someone who can help them in whatever they need, but kind of improve their financial health. I think that'd be really good.
And their financial literacy, right? And
Yeah.
people need to understand that, like, there are, there's this common misconception that, like, the wealthy stay wealthy because of this. But actually, they're just a little bit more educated in these places because they get access to that education.
Yeah.
Whereas people from typically communities like one I grew up in, for example, like wouldn't have access to that information. So again, like there's a lot of free resources.
Yeah.
Tax Queen's one of them.
Yeah.
HMRC will give you some resources, but it's that demystifying, isn't it? Like,
Absolutely.
I think one thing that Pie really helps with, and it's a big help, is no one really wants to speak to HMRC, right? There's this like irrational fear.
Also, they can't get through to them.
Oh, yeah, there's that.
That's the main thing.
Maybe it's a rational fear, but like people think that they're going to get in trouble. They think that if they ring HMRC, there's going to be some sort of stealth tax that they've missed and they're going to be hit with a bill.
Oh, absolutely. People are absolutely terrified of their taxes. And that is one thing that I'm trying to take away. It's not scary. If you take control of it, you can do it. Anyone can do it.
If you're looking to do self-assessment, for example, the point of self-assessment is it's done by yourself, right?
Yeah.
Do you need a qualified accountant to do that? Or
I mean, absolutely not. And I'm saying this as a qualified accountant. I think it also depends on the complexities of your tax returns, because sometimes, I've come across very complex ones with overseas income and, it does get quite tricky. But if you're a sole trader in the UK and you kind of... when I say basic accounts, I mean, you see your income coming in, you see your expenses going out, you should be able to use our platform, Pie, to do it yourself. And it really makes it incredibly straightforward because you have this app which links to your bank, which you link to your bank. All the transactions flow through. You categorize your transactions. You look at it. It basically does your tax return for you. You click submit to HMRC, and it's gone. And of course, you can get additional support. You can get someone to check the your tax return, but you really should be able to do it yourself. I have so many videos on my page that can help you. There are many accountants at Pie who will give you support. That is an additional cost, but it's like £69 a year for unlimited tax support through the year. So it shouldn't, the thing that we're trying to do at Pie is to try and make it incredibly accessible to everybody. I know what I would charge to do a tax return, and you don't need to pay that. You don't need to be paying for a qualified accountant to do it for you, especially if you were doing it on the HMRC website yourself previously, which is now closing in April 2026, which is why Pie came about in the first place. I just want to say it's closing for people that are earning more than £50,000, and then it's kind of being phased out. So it's not for everybody, but it's been.
And that's the Making Tax Digital.
That's the Making Tax Digital, yes.
Yeah, fine. Okay.
So you really should be able to kind of feel empowered, know that you can have confidence in yourself, and that's what I'm trying to do through my page, is try and give people the confidence to be able to do it themselves.
And I think people listening will find that reassuring, that like the key thing here is like the simplicity of it, right?
Yeah.
You can, if you want to lower your tax liability and you choose a pension to do it and you choose InvestEngine to do it, that transaction flows through Pie, it's all fed in, your tax liability is taken care of, and you just simply double check it or ask for support.
Yeah.
And then you just submit it to HMRC.
Yeah.
So it's really simple to do. But again, it's these like small, simple, actionable steps that people maybe are a little bit confused by.
Yeah, I mean, I do feel like the government has made the entire tax system so complicated that it is incredibly daunting for people coming into it with no financial background. But I mean, the hope is that will change, but I highly doubt that it will change. But it would just be so much easier if people just had, one or two taxes, and they could deal with it themselves and not be so daunted by it.
So the tax system is like daunting. I think I read on your website it's like 100,000 pages long or something, or different accounting sort of metrics. What's like your most obscure tax? What's like the most obscure one you look at and think that is so ancient, or maybe it's just niche?
So funny you say ancient. So now they're kind of pretty boring, the taxes, like you've got your capital gains, your income tax and whatnot. But back in the day, there were really obscure taxes. So one of them, I think it was like 17th or 18th century, I can't remember. There was something called a bachelor tax.
A bachelor tax.
Bachelor tax. So if you were a single man, you had to pay an additional tax. I don't know what it was actually on, but you had to pay an additional tax because they were trying to encourage men to get married and have families. So you were penalized for being single, basically.
So as soon as you were 18 and you were a taxpayer, here's an extra tax because you're single.
Yeah.
Very interesting.
This is interesting.
And it wasn't, obviously marriage was the key outcome there. You had to get married to not pay the tax.
Yeah.
Are there any others you can sort of share? Any other sort of like obscure ones like that?
There's one, I don't know any others, I mean, from back in the day, but there's one which is quite funny, which is about, I think it's called pastry tax or pie tax. I'm not quite sure. I mean, if it was pie tax, that'd be perfect for me.
Yeah.
But essentially, if you get like a pastry, so like a pie or sausage roll or something, and you get it delivered hot, it's subject to VAT. If it kind of cools down naturally, so it's kind of warm and cooling down, it's not subject to that. So then there was this whole thing in the news about Greggs sausage rolls.
Right.
About whether they purposefully cool them down so that they're cheaper for the customer because they're not subject to that.
Wow.
Yeah.
Strange.
Yeah.
So we talk about sort of different tax styles. I mean, not investment advice, but walk me through what the tax queen's investment style is. Like, what do you like the look of? Do you use ISAs? Do you use SIPs, junior ISAs? Like, what does your investment style and strategy look like?
So I use everything that you've just said. I think, kind of like I've said before, I think it's really important to plan for financial freedom. So, you know, I've got my ISAs for kind of like my 10-year growth, and then, which obviously I can keep in for longer if I want to and keep growing. And then I've got my SIP for retirement, which I know obviously I'm not going to see until retirement age. So, and also with my children, I think one of the best things, obviously, other than, you know, unconditional love and everything like that, if you can set them up in a world where we don't know where this is going. I mean, the world is not looking great at the moment in terms of prosperity in the country. So if you can kind of try and set them up a bit and kind of get them investing, and then once they're at the age of 18, hopefully you would have had the conversations with them because it goes straight into their name. They're in control of it from 18. So you would then hope that they would, you've kind of given them the knowledge and the advice to continue with the growth. That's my strategy. It's all about freedom, kind of growing for freedom.
And even if that pot means that it's a first car, it's a deposit on a house, if you're lucky enough to, you know, pay in a lot, it could be finish university debt-free if you choose to go to university. Like,
absolutely.
And it's about getting that leg up, isn't it?
Yeah.
You know, making that a bit more accessible and helping people, have a little bit more prosperity. That's a really, really good point. So in terms of like your investment strategy, like, are there things you like the look of? Like, do you like tech? Do you like healthcare? Do you like the accounting firms, as you mentioned?
So I like tech.
Okay.
I do like tech. I mean, you're much more knowledgeable about all of this stuff than I am. I do like I don't know what you call them, the stocks that are like the big stocks, the big 10 stocks. What do you call them?
Magnificent Seven.
But, the Magnificent Seven, fine. Yeah. So I have invested in the Magnificent Seven.
Okay.
And I have seen quite a lot of growth there. I have kind of made a few punts in the past, which haven't always worked at all. But the Magnificent Seven, I'm quite risk averse when it comes to the stocks.
That's interesting because the Magnificent Seven can be seen as quite risk tolerant, because obviously because they're kind of they're you know, America is kind of considered at the moment overvalued. Again, not investment advice, but a lot of people in the industry are saying like the US over indexes or has an overweighting in the oil world, MSCI oil world, FTSE oil world. So and the Magnificent Seven are very sort of like tech-based companies. So you kind of like have like this concentration of your portfolio of like tech-focused, AI-focused, that sort of thing. So it's really interesting that you say, again, a lot of our listeners will say, oh, I'm very risk-averse, I don't want to lose any money, and then have what a lot of people in the industry would consider like a non-diversified, very risk-tolerant portfolio.
I do also have some investments in the funds, so like the so the ETFs, like the index funds. But no, I do like a stock, like a single stock as well.
Yeah, like a Magnificent Seven stock or like an AI stock.
Yes.
Okay, fine.
What about you?
Yeah, again, I'm very boring. It's diversified. It kind of follows like an all-world index. Follows well, it's an InvestEngine portfolio. ETF portfolio follows a mix of different things. So exposure to the UK, to Europe, to the US. I try to follow rankings to like what MSCI and FTSE, so what their rankings are. But again, I am not an investment expert. I'm not qualified to give financial advice, but I just try and have this well-rounded, diversified portfolio.
I've got to say, diversification is key. That is what I would encourage.
I think so. And I think, like, look, having a tactical allocation to things that, like, you think are either cool or that you align with can be good to keep you engaged. Probably not always the, best strategy. Like, if you think that if you really like AI, for example, like a lot of people who are qualified to give this advice will tell you that putting all of your pension into AI is probably not the sensible thing to do. But yeah, I think as long as I think the main thing is getting people investing and getting them to understand that, like, look, you need to start. Starting is the main thing. Once you start, once you consume this financial education and hopefully you get a little bit more confident, you learn a bit more about diversification, like all of these can obviously help you get ahead, help you make informed investment decisions. But yeah, I think just a well-rounded portfolio is probably the sensible strategy. And then have thematic positions. Like if you want to take up an AI-themed ETF, if you want to take a punt on a Magnificent Seven stock in isolation, if defense is your thing, then yeah, have tactical allocations by all means, but make that a satellite position, not not an overall portfolio decision, which I think is the main thing. If you were in charge of the UK tax system then, so tomorrow, Charlotte, the tax queen, is in charge of the entire UK tax system. What would you change? What would be the things that you do?
I mean, I've said many times here that I think the system is far too complicated, to the point that people are absolutely terrified of taxes. They don't even try and understand them. I think they need to scrap everything and start from scratch and seriously reduce taxes, because I truly believe in the Laffer curve. Have you heard of the Laffer curve?
No.
So I've never studied economics, but I've heard about the Laffer curve and I really believe in it. So the Laffer curve is a curve where it correlates tax revenues with tax rates with tax revenues for the country. So the graph starts going up. When you start increasing taxes, obviously tax revenues go up, which is great. Then it's a happy medium point at the top, which is like the optimum tax rate for tax revenues. And then it goes down, which means that the higher the tax rates are, the lower the tax revenues are, because people might leave, people might they might physically leave, or they might kind of incorporate their businesses, for example, in other countries and, to tax havens or whatever they decide to do. And I just feel like the more that the country are raising taxes, first of all, people are just horrendous. Like they're just so in such a poor position at the moment. Like the cost of living crisis is insane. But the fact is, the people that pay the most amount of tax in the country are fleeing the country, which means that it's going to put an even higher pressure on the people that are left in the country. Like the working class, middle class people are going to be really badly hit. So I think that they need to significantly lower their taxes. That's the first thing that I would do.
Do you think as well, like, I mean, everyone says, and this has been kind of like the running comment of, we're not increasing taxes on working people. But if you own a business and your costs are increased, that's typically, that doesn't come out of your pocket. You pass that cost on to the consumer, right?
Absolutely. The more tax revenues the government take, the more spending they do. So as well as reducing taxes, I would significantly reduce spending. I would do a complete overhaul of the welfare system. I just think that everything has just gone completely out of control, and they just need to bring everything back to basics and start again. And I feel like what's going on in politics at the moment is all the politicians care about are their votes. And I understand that is the game that you play in politics. But the fact is, it's really impacting everybody. And they just need to stop thinking about ego and do what's actually right. And I really do believe that they need to be reducing their taxes and let the economy grow. They're not letting anything grow. There's no prosperity at the moment because it's not encouraging growth.
Look, this has been great, Charlotte. Really insightful, and I'm sure people will find a lot of value for this. And if where can people find you if they want more insight?
So they can find me on Instagram, TikTok, at tax.queen.c, and I post every single day. And if you've got anything, if the viewers have anything kind of in particular they want to know about, I always love kind of hearing ideas, and then I'll make them into videos, because I'm all about kind of spreading education and just helping people. So if I get a lot of questions about something, I always make a post on it.
Nice. So listen to this podcast, visit the Tax Queen.
Yeah.
Look at InvestEngine's partnership with Pie.
Yeah.
Use Pie to help with your taxes where necessary. Before you go, Charlotte, what is one piece of advice or learning? It can be career, wealth, wisdom, anything at all, life, that you'd like to share with our next guest?
Oh, with our next guest. Okay. I mean, I'm going to make it about tax and about tax, but just about finances in general. Don't wait until you're ready, because the earlier you start, the more time you have to grow. And I think that is something, if you get that in your head, I feel like it's just a fundamental way of thinking. I mean, you can use it in all different aspects of life, but if you've got a worry, if something's happening, deal with it now, and then you've got longer to deal with it. Just start now before you're ready, because if you keep waiting, you're never going to be fully ready to start something. So start now.
Start now. Nice.